In the high-stakes world of Wall Street, legends are made and broken in the blink of an eye. But there's one story that even the most seasoned traders whisper about: a tale of hubris, catastrophe, and an unlikely redemption that would reshape the entire landscape of finance. The year was 1982. Ray Dalio, a young hedge fund manager with a reputation for brilliance, stood before a sea of flickering screens. The air crackled with tension as he surveyed the economic landscape, convinced he'd spotted a looming disaster that would shake markets to their core. Dalio wasn't just confident, he was certain. So certain that he bet everything on a single, massive trade. He positioned Bridgewater Associates, his fledgling firm, to profit from an economic collapse he saw as inevitable. Emerging market debt was his weapon of choice, a high-risk play that would pay off spectacularly if he was right. But the markets had other plans. Instead of crashing, they surged. Dalio watched in horror as his predictions crumbled, and with them, the very foundation of his company. The losses mounted at a dizzying pace. In a matter of weeks, Bridgewater teetered on the brink of bankruptcy. The fallout was swift and merciless. Dalio was forced to lay off nearly every employee, his reputation in tatters. The whispers on Wall Street turned from admiration to mockery. How could someone so smart get it so catastrophically wrong? In a final, humbling blow, Dalio had to borrow $4,000 from his father just to keep the lights on. It was a staggering fall from grace, the kind of mistake that usually ends careers and shatters dreams. But here's the twist that makes this story more than just another cautionary tale of Wall Street excess. That colossal failure became the catalyst for one of the most revolutionary transformations in financial history. As Dalio stood in the wreckage of his ambitions, he faced a choice. He could retreat, licking his wounds and fading into obscurity like so many failed traders before him. Or he could do something truly radical: embrace the failure, learn from it, and use it as the cornerstone for an entirely new approach to investing. He chose the latter, and in doing so, he planted the seeds of a system that would not only resurrect Bridgewater, but propel it to heights few could have imagined. The key insight that emerged from the ashes of 1982 was simple but profound. No one, not even a supposed genius, is infallible. The real power lies not in being right all the time, but in creating an environment where ideas can be rigorously tested, where mistakes are not just accepted, but actively sought out and learned from. This realization led Dalio to develop a culture of radical transparency at Bridgewater. Every meeting, every decision, every potential trade would be scrutinized from all angles. No hierarchy was sacred. The newest intern could challenge the most senior partner if they had data to back up their argument. It was a complete inversion of the typical Wall Street power structure. Instead of a top-down approach where the boss's word was law, Bridgewater became a meritocracy of ideas. The best concepts would rise to the top, regardless of their source. This wasn't just feel-good corporate speak. Dalio codified these principles into a 123-page manifesto that became required reading for every Bridgewater employee. It outlined a system of constant feedback, rigorous debate, and relentless self-examination. The results were staggering. Over the next 3 decades, Bridgewater grew from a tiny office above a shopping center to the world's largest hedge fund, managing over $150 billion at its peak. Dalio himself became a billionaire many times over, his name spoken with reverence in financial circles. But the story doesn't end there, because even as Bridgewater reached dizzying heights, the lessons of 1982 would be tested once again, this time on a scale that threatened not just one man's career, but the entire global financial system. Fast forward to 2020. The world is in the grip of a pandemic, markets are in freefall, and Bridgewater's vaunted risk parity strategies, complex algorithms designed to balance risk across multiple asset classes, are faltering badly. In a matter of months, Bridgewater's flagship Pure Alpha fund plummeted by 18%. Investors, panicked by the losses and the general economic uncertainty, began pulling out their money en masse. By the end of the year, Bridgewater had seen a staggering $70 billion in withdrawals. It was a crisis that echoed the disaster of 1982, but on a far grander scale. Once again, Dalio and his firm faced existential questions. Had they grown too big, too complacent? Had the very systems designed to prevent catastrophic losses failed when they were needed most? The parallels to that long-ago crisis were striking, but this time, Bridgewater had something it didn't have in 1982: a culture built on confronting failure head-on. As the withdrawals mounted and critics circled, Dalio and his team didn't retreat. Instead, they doubled down on their principles of radical transparency. They analyzed every aspect of their models, invited dissenting opinions, and openly acknowledged where they had fallen short. It was a high-wire act, balancing the need to admit mistakes with the imperative of maintaining investor confidence. But it was precisely this willingness to confront hard truths that had built Bridgewater into a powerhouse. Now, that same ethos would be put to the ultimate test. The outcome of this latest crisis is still unfolding. Bridgewater has stabilized, but questions remain about its long-term trajectory. What's clear, however, is that the lessons learned from that fateful trade in 1982 continue to shape not just one firm, but an entire industry's approach to risk, failure, and resilience. So what can we learn from Ray Dalio's $15 billion mistake and the even bigger challenges that followed? Perhaps it's this: true success isn't about never failing. It's about creating systems that turn failure into fuel for growth. It's about building a culture that values truth over ego, that sees setbacks not as endpoints, but as opportunities for transformation. In a world that often celebrates only victories, Dalio's story reminds us of the hidden power of defeat. It challenges us to ask, what if our greatest failures aren't things to be buried or forgotten, but the very foundations upon which we can build something truly extraordinary? As we reflect on this tale of catastrophe and comeback, it's worth asking ourselves, have we ever had a mistake that threatened everything, but ended up teaching us more than success ever could? And if so, how did we use that lesson to reshape our own world? In the end, Ray Dalio's legacy may not be the billions he made or the records he broke. It might just be the radical idea that in embracing our failures truly, deeply embracing them, we unlock the potential for our greatest triumphs. Picture this: a young, ambitious hedge fund manager staring at a sea of red numbers flickering across his computer screens. The year is 1982, and Ray Dalio has just made a catastrophic bet that would nearly destroy his fledgling company, Bridgewater Associates. But little did he know, this colossal failure would become the catalyst for one of the most revolutionary transformations in Wall Street history. As the dust settled on Dalio's disastrous trade, he faced a stark choice: retreat into obscurity or confront his mistakes head-on, in a move that would define his career. Dalio chose the latter. He didn't just analyze what went wrong, he completely reimagined how a financial institution could operate. It was the best thing that ever happened to me, Dalio would later reflect, his voice tinged with the wisdom of hindsight. This wasn't just empty rhetoric, Dalio said, about crafting a culture at Bridgewater that would turn failure into fuel for success. Enter the era of radical transparency, an idea meritocracy at Bridgewater. These weren't just buzzwords, they became the bedrock of a new way of doing business. Imagine a workplace where every mistake is not just acknowledged, but celebrated as a learning opportunity, where the lowest-ranking employee can challenge the CEO's ideas without fear of repercussion. Dalio introduced a system of relentless documentation. Every meeting, every decision, every failure, all meticulously recorded and analyzed. It wasn't about pointing fingers, it was about creating a living, breathing playbook for better decision-making. But Dalio didn't stop there. He developed tools like the Dot Collector, a piece of software that allowed employees to rate each other's ideas in real time during meetings. Picture a boardroom where egos are checked at the door, and the best ideas rise to the top, regardless of who proposed them. This culture of radical openness and constant improvement didn't just help Bridgewater survive, it propelled the firm to dizzying heights. Under Dalio's leadership, Bridgewater grew to become the world's largest hedge fund, managing over $150 billion in assets at its peak. The transformation was nothing short of remarkable. From the ashes of that 1982 failure rose an institution that didn't just weather market storms, it thrived in them. Bridgewater's success became a testament to the power of embracing failure and harnessing it as a force for positive change. But here's where our story takes an unexpected turn. Years after Dalio's initial stumble, Bridgewater would face another crisis, one that would test the very principles it was built upon. A $15 billion crash that, to this day, many on Wall Street prefer to pretend never happened. As we delve deeper into this hidden chapter of Bridgewater's history, ask yourself, how do the principles of radical transparency hold up when billions are on the line? Can a culture built on admitting mistakes survive when the stakes are at their highest? The answers to these questions reveal not just the strengths of Dalio's system, but also its potential vulnerabilities. They force us to confront the delicate balance between transparency and maintaining confidence in a world where perception can be as powerful as reality. Bridgewater's journey from near collapse to industry titan is a masterclass in resilience and adaptability. but it's also a cautionary tale about the challenges of maintaining those principles in the face of enormous pressure. As we explore this lesser-known crisis, we'll see how Bridgewater's culture was put to the ultimate test. We'll witness the tension between the ideals of radical transparency and the practical realities of managing a global financial powerhouse. Did Bridgewater's commitment to openness help or hinder its response to this new challenge? How did Dalio and his team navigate the treacherous waters of a major setback while still adhering to their core principles? These questions cut to the heart of what it means to build a truly resilient organization. They challenge us to think about how we handle failure in our own lives and careers. Are we willing to confront our mistakes head-on, or do we sweep them under the rug? Dalio's approach suggests that true strength comes not from avoiding failure, but from embracing it as an opportunity for growth. It's a philosophy that flies in the face of conventional wisdom, especially in the high-stakes world of finance. But as we'll see, even the most well-designed systems can face unexpected challenges. The $15 billion crash that rocked Bridgewater in recent years put Dalio's principles to their toughest test yet. This hidden crisis forced Bridgewater to confront a difficult question. How do you maintain a culture of radical transparency when the very act of admitting failure could potentially undermine investor confidence? It's a dilemma that gets to the heart of the delicate balance between honesty and self-preservation in the business world. Can a company truly be transparent about its mistakes without risking its own survival? As we unpack this lesser-known chapter in Bridgewater's history, we'll see how Dalio and his team grappled with these complex issues. We'll explore the tension between the ideals of openness and the practical realities of managing a multi-billion-dollar fund. The story of Bridgewater's hidden crisis offers valuable lessons for anyone interested in building resilient organizations or navigating their own professional setbacks. It challenges us to think deeply about how we handle failure and what it truly means to learn from our mistakes. As we dive into the details of this $15 billion stumble, keep in mind the journey that brought Bridgewater to this point. From the ashes of that 1980 to failure, Dalio built an empire on the principles of radical transparency and idea meritocracy. But would those same principles that fueled Bridgewater's rise be enough to see it through this new challenge? Or would the pressures of the market force a compromise of these deeply held values? The answers to these questions reveal not just the strengths and weaknesses of Dalio's system, but also offer insights into the nature of failure and resilience in the modern business world. As we explore this hidden crisis, we'll see how Bridgewater's culture was put to the ultimate test. We'll witness the struggle to maintain transparency in the face of massive losses, and the delicate dance between admitting mistakes and maintaining investor confidence. This story forces us to confront some uncomfortable truths about the nature of failure and success in high-stakes environments. It challenges our assumptions about what it means to be truly transparent and accountable in the world of finance. But perhaps most importantly, it offers a window into the ongoing evolution of Dalio's principles. How does a system designed to learn from failure adapt when the stakes are higher than ever before? As we unravel the details of this $15 billion setback, we'll see how Bridgewater's response to this crisis has shaped its trajectory in the years since. We'll explore the lasting impact of this hidden chapter on the firm's culture, its reputation, and its approach to risk management. The lessons learned from this experience extend far beyond the walls of Bridgewater. They offer valuable insights for anyone looking to build resilient organizations or navigate their own professional challenges. So as we dive deeper into this story, ask yourself, how would you handle a $15 billion mistake? Would you have the courage to confront it head-on? Or would the temptation to sweep it under the rug be too strong to resist? The answers to these questions reveal not just the strengths and weaknesses of Dalio's system, but also offer a mirror for our own attitudes towards failure and transparency in our professional lives. As we explore the hidden crisis that shook Bridgewater to its core, we'll see how the principles of radical transparency and idea meritocracy were put to their ultimate test. We'll witness the struggle to maintain openness in the face of massive losses, and the delicate balance between admitting mistakes and preserving investor confidence. This story challenges us to think deeply about what it truly means to learn from failure. It forces us to confront the uncomfortable reality that even the most well-designed systems can face unexpected challenges. But perhaps most importantly, it offers a glimpse into the ongoing evolution of Dalio's principles. How does a culture built on embracing failure adapt when the stakes are higher than ever before? As we unpack the details of this $15 billion stumble, we'll see how Bridgewater's response has shaped its trajectory in the years since. We'll explore the lasting impact of this hidden chapter on the firm's culture, its reputation, and its approach to risk management. The lessons learned from this experience extend far beyond the world of finance. They offer valuable insights for anyone looking to build resilient organizations or navigate their own professional setbacks. So as we delve deeper into this story, ask yourself, how would you handle a $15 billion mistake? Would you have the courage to confront it head-on? Or would the temptation to hide it be too strong to resist? The answers to these questions reveal not just the strengths and weaknesses of Dalio's system, but also offer a mirror for our own attitudes towards failure and transparency in our professional lives. As we explore this hidden crisis, we'll see how Bridgewater's culture was put to the ultimate test. We'll witness the struggle to maintain transparency in the face of massive losses, and the delicate dance between admitting mistakes and maintaining investor confidence. This story forces us to confront some uncomfortable truths about the nature of failure and success in high-stakes environments. It challenges our assumptions about what it means to be truly transparent and accountable in the world of finance. But perhaps most importantly, it offers a window into the ongoing evolution of Dalio's principles. How does a system designed to learn from failure adapt when the stakes are higher than ever before? In the world of high finance, success stories are celebrated, but failures? They're often swept under the rug, forgotten as if they never happened. But what if I told you that one of the most successful hedge funds in history, Bridgewater Associates, faced a crisis so severe it threatened to unravel decades of carefully crafted reputation? Let's rewind to the post-2008 era. Bridgewater, under the leadership of Ray Dalio, launched a groundbreaking strategy called risk parity with their all-weather fund. It was hailed as a revolutionary approach, promising stable returns regardless of market conditions. For years, it worked like a charm, attracting billions in investments and cementing Bridgewater's status as a Wall Street powerhouse. But as the saying goes, what goes up must come down, and down it went. After years of stellar performance, the risk parity strategy began to falter. The 2020 to 2022 market cycle proved particularly brutal, exposing cracks in what was once thought to be an impenetrable fortress of financial engineering. Investors, once enamored with the promise of all-weather stability, began to lose faith. The exodus was staggering. Between 2019 and 2023, a mind-boggling $70 billion was withdrawn from risk parity strategies. It wasn't just a stumble, it was a full-blown crisis that sent shockwaves through the industry. Yet, if you were to scour the financial news today, you'd be hard-pressed to find much mention of this massive setback. It's as if the entire episode has been erased from Wall Street's collective memory. The question is, why? The answer lies in the uncomfortable truth that this failure wasn't just about one fund or one strategy. It reflected deeper, systemic flaws in the way Wall Street operates. And that's not a story anyone in the industry is eager to tell. You see, Wall Street thrives on narratives of triumph over adversity, of visionary leaders making bold bets and winning big. But when failure strikes at the very foundations of their most vaunted strategies, the response is often silence. It's easier to pretend it never happened than to confront the uncomfortable realities it exposes. This erasure of error isn't just about protecting reputations. It's about maintaining the illusion of infallibility that keeps the money flowing. After all, who wants to invest with a firm that admits to losing billions? But here's the real danger. When we ignore mistakes, we lose the opportunity to learn from them. We perpetuate a cycle of hubris that sets the stage for even bigger failures down the line. So, as we reflect on this hidden crisis, we're left with a pressing question. Is ignoring mistakes the real danger, or is it simply the price we pay for protecting reputations in the high-stakes world of finance? The truth is, there's no easy answer. But one thing is clear. As long as Wall Street continues to erase its errors, who will hold them accountable? And more importantly, who will ensure that the lessons of these hidden crises are learned before history repeats itself? In the end, perhaps the most valuable skill in finance isn't the ability to make money, but the courage to face failure head-on and learn from it. Because in a world where even $15 billion mistakes can vanish into thin air, the biggest risk of all might be pretending that we're infallible.